Here's your expanded, fully original script for the finance channel, built from the value line dividend breakdown but going well beyond it with historical context and investor psychology that wasn't in the source. Imagine buying a stock today with a fat dividend check landing in your account every 3 months, only to watch that same company freeze your payout for 2 straight years, while your neighbor's boring tech stock quietly doubled its dividend during the same stretch. That is not a hypothetical, that happened, and if you only looked at the number on the screen called yield, you would have picked the wrong one every single time. Today we are going to break down 6 of the biggest names on the stock market, the same 6 companies pension funds, hedge funds, and everyday retirees all watch closely, and we are going to expose the one mistake that costs new dividend investors thousands of dollars and missed growth. Stick with me because by the end of this you will never look at a dividend yield the same way again. Most people learn investing backwards. They open an app, sort every stock by dividend yield from highest to lowest, and by whatever sits at the top. It feels smart. It feels like free money, but yield is only a ratio, the dividend divided by the price. And a ratio can lie to you in 2 completely different ways. Sometimes a company pays a big dividend because it is healthy and generous with its cash. Sometimes a company pays a big dividend because its stock price has been crushed and the market is terrified something is about to break. Those 2 companies can show the exact same yield on your screen and represent 2 completely different futures. This is the same trap that caught thousands of investors during the 2008 financial crisis, when several high-yielding bank and energy stocks looked like bargains right up until the dividends were slashed to nothing. The lesson from that era still holds today. A high yield is not a reward, it is a question mark that you have to answer yourself. So instead of chasing yield, professional investors ask a completely different question first. How has this dividend grown over time, and where did that growth actually come from? A retailer that raised its dividend by double digits for a decade sounds impressive, but if most of that growth happened during a housing boom when money was cheap and consumers were in the country, that growth rate was borrowed from good weather, not built on a storm-proof foundation. Compare that to a beverage company that only raises its dividend by 4 or 5% a year, but has done it through wars, recessions, oil shocks, and global pandemics without ever missing a single payment. Slow and boring can quietly outperform fast and fragile, especially once you measure it across 30 years instead of 3. But here is where things get interesting, because the size of the dividend increase means almost nothing without knowing the starting point. A tech giant that jumps its dividend by 90% sounds like the growth story of the decade, and headlines will scream about it. What those headlines will not tell you is that the dividend started from almost nothing. So a huge percentage increase still leaves you with pocket change in actual dollars. This is one of the oldest tricks in financial marketing, and it works because our brains are wired to respond to big percentages, not small numbers. A smart investor learns to ask 2 questions every time, not just how fast did it grow, but how much money does that growth actually put in my pocket today? Now let's talk about the part almost nobody explains properly, the payout ratio, which is simply how much of a company's profit gets sent out the door as dividends instead of staying inside the business. A company that pays out 65% of its earnings might sound risky compared to one paying out 20. Until you realize the first company sells people by every single day, rain or shine, while the second company depends on a product cycle that could slow down overnight. The payout ratio only means something when you pair it with how predictable the underlying business actually is. This is exactly why energy companies can offer the juiciest yields on the entire stock market while quietly being some of the riskiest dividend payers alive. Because their profits swing wildly with oil prices they do not control, prices set halfway across the world by decisions made in rooms these companies are not even in. There is a psychological trap hiding inside every one of these decisions too. Investors love the feeling of a quarterly check landing in their account. It feels like proof that they made a good decision. But that feeling can quietly override logic, causing people to hold onto a stock purely because of the dividend, even after the business behind it has started to weaken. Behavioral economists call this anchoring, where the first number you focus on, in this case a big fat yield, becomes the lens through which you judge everything else, even new evidence that should be changing your mind. The check feels real, the risk building underneath it often does not, until the day it suddenly does. The final piece almost nobody talks about is what account you hold these dividends inside. A dividend reinvested inside a retirement account can see completely untouched by taxes for decades. That same dividend reinvested inside a normal taxable account gets taxed the year you receive it, whether you spent the money or not. Two investors can own the identical stock, reinvest the identical, and end up with two very different results 20 years later purely because of where they parked their money. This single, often made in the first 5 minutes of opening an account, can be worth more over a lifetime than picking the perfect stock ever will. So the real skill in dividend investing was never about finding the highest number on the screen.